Bismillahir Rahmanir Rahim. With the name of Allah, the most merciful and the most beneficent. The same topic as it was in lecture 1. Lecture 2, we will continue the same topic, capital structure theories. We did discuss the first two theories, net income approach and traditional approach. In this video, we will discuss these 5 theories of capital structure. So first of all is Modigliani and Miller theory. It's also called irrelevancy theories. This theory supports the net operating income approach and the negate traditional approach because Modigliani and Miller hypothesize or postulates that capital structures have no impact or has nothing got to do with the market value of the firms. No matter how much debt the company implied, it will not increase or decrease its value in the market. So why it is called irrelevancy theory? Because it postulates that capital structure is irrelevant in firm valuations. There are 3 things basically in the relationship with the capital structure. One is cost of capital, second is value of the firm, and third is capital structure. Changes in the capital structure, according to or Modigliani and Miller, these are the 2 economists who hypothesize this theory that weighted average cost of capital does not impact or affected by mix of a capital, debt, and equity. The difference between net operating income approach and the irrelevancy theory in the basis of the process, arbitrage process and homemade derivative. These 2 terms will be explained in incoming videos. Graphically, if degree of leverage, no matter how much it is, increases, the weighted average cost of capital or overall cost of capital of a firm doesn't change. It remains same, even if we increases the degree of leverages as it represented in the excesses. This is basically the propositions or hypothesis propositions of the Modigliani and Miller. Proposition and relationship between cost of capital, capital structure, and value of the firm are given below. Modigliani and Miller argued that required that cost of a capital or overall cost of the firms, that what is called weighted average cost of capital, doesn't depend on capital structure. It is equal to required rate of investors who are investing in that equity class. So the equity class have same risk and accordingly have same expected return. Second, he said that arbitrage mechanism will automatically equate equity prices of levered firms or those who are using debt and unlevered firms who are fully financed by equity. Secondly, even investor can replicate the capital structure of the levered firms in their personal capacity, which is called homemade leverages. The situation is explained by the illustration. Suppose that there are 2 firms, A Limited and B Limited. Both are same in all respects except in a composition of capital structure. Firm A are not using a debt, that is 0, while firm B implied 400,000, that is almost 40% of the overall capital. Now, let's assume that earning before interest and tax, which is called operating income, is 100,000 for the both forms. Interest expense on a debt, let's suppose 5% is in debt cost, so 20,000 is interest expense for the form B. Now, earning available to shareholder is 100,000, while in B it is 80,000. Let's suppose required cost of equity for firm A is 10% and B is 12%. That is given according to traditional approach. Cost of equity increases with increase in debt. Value of the firms on the basis of required rate. So we will calculate value of the firm according to these rates. Value of equity, that is basically calculated is this amount divided by cost of equity, and it is calculated by this amount, that is equity available to shareholder divided by cost of equity, that is equal to 667. So cost of debt is 0 in first case in case of A Limited, while in case of B Limited it is 400,000. Value of the firm is so total value of equity and value of debt. Sorry, that is not cost, that is value of debt. Value of debt in case of B is 400,000. So overall value of the firms of A is 1 million, while from B is 1,066,667. Now, weighted average cost of capital is basically calculated by the formula, that is 10%, because it doesn't imply debt, so the weighted average cost of capital will be equal to debt. While in second case, it is the cost of value of equity divided by total value of firm multiplied by cost of equity. Value of debt divided by total value of firm multiplied by cost of debt, that is equal to 9.38. So according to traditional approach, value of the firm increases with the debt and weighted average cost of capital decreases. But Miller and Modigliani argues that this situation will not persist for a longer period of time because of arbitrage process amongst investors. What is arbitrage process? Let it be explained in coming slides. Homemade leverage and arbitrage process. Assume that Mr. Shafiq has 1% stock of B Limited. So 1% of B is stock of B is 6,666. He will dispose 1% of stock of B Limited at that much and borrow 1% of debt of B Limited that much, 4,000. So he will he is going to make homemade leverages. He will dispose B Limited stock. He will get or borrowed 1% amount of that specific B Limited firm is 4,000. So he will total amount now to invest anywhere is 10,666. He then invest in A Limited and buy his shares. A Limited its shares. Percentage of the A Limited now he has is 1.067%. Now we will calculate earning for Mr. Shafiq from A Limited. Now, since 1% of earnings of A Limited is 1066.67 according to this percentage. Now, because Shafiq has 1.067 percentage of ownership in A Limited when he invested that much amount. So according to that percentage, he is earning portion is that much. Interest on borrowed amount is 200 because he has borrowed 200 rupees from open market. Now, this minus this, Mr. Shafiq, earning available to Mr. Shafiq is 866.67. Now come to according to 1% of the shares, so 1% of that earning become 800. There is no borrowing, so it is zero. Total amount available to Mr. Shafiq is 800. Now, when he shifted from B Limited to A Limited, he have a profit of 66.67 rupees. What will happen that investor will start disposing of shares of B Limited and will start investing in A Limited. This will increase the demand of A Limited while they increase the supply of B Limited. So value of the B Limited will decrease and value of the A Limited will increase. The process will continue. The arbitrage process will continue when this arbitrage profit is wiped out from the market. This will be the situation of equilibrium. It will equate the market value of A Limited and B Limited in the same positions. So homemade leverage is basically that Mr. Shafiq replicate the same capital structure as it was in B Limited in his personal capacity. While arbitrage process is a process where investor earn riskless profit from the market conditions or from the segment of the market or from the different geographical market. But this arbitrage process will continue unless and until the profit becomes zero. So in this case, the arbitrage process is disposing of B Limited share while buying A Limited share. An investor will end up with the profit. This profit will wipe out in a situation when the market becomes in equilibrium and arbitrage process ceases to exist. So Miller and Modigliani proposition says that the situation that are explained by trade-off theory will no more exist because of homemade leverages and because of arbitrage processes. Finally, LM says that capital structures are mixing of debt and equity have no impact on valuation of the firms. There are certain criticisms on Miller and Modigliani and Miller approach or MM theory. That assumptions are unrealistic. Assumptions are perfect capital market, no single buyer should not beat the market. These are basically assumptions of the theory which is unrealistic and not exist in a practical market. Arbitrage process is imperfect market is of no use. Arbitrage process is basically if the market is imperfect, then there is no symmetrical information available to all investors. So all investors will not participate in arbitrage process, and arbitrage process will be unable to bring the situation in equilibrium between the A Limited and B Limited or in both the companies. Transaction cost exists in real world, which make the buying and selling process more costly. So the opportunity of profit ceases to exist. It also have an impact on arbitrage process. Homemade leverages is not alternative for corporate leverages. Uh, Corporations, the cost of debt for corporation is quite different, while the cost of debt for individual is different. Debt are not available at the same cost. So homemade leverages is not a pure alternate for corporate leverages. MM ignore tax, taxes which provide tax saving and interest expense for a levered firm. So the firms who implied debt in their capital structure will enjoy a tax benefit for a longer period of time, which will increase their value. Trade-off theory are Modigliani and Miller relevancy theories. Later on, these two economists revised a study and considered taxes in their capital structure decisions. They concluded that within with the tax with relaxing the assumption about the taxes, the value of the firm will increase by the amount of the tax saving or the present value of the tax saving that the company is obtaining from the interest expenses. Interest on a debt is tax deductible expense, while payment to shareholder in case of dividend or preferred on dividend and preferred stock is not admissible for tax deductions. So, applying wholly equity in financing the firms will not give you any tax benefit, while using a debt in your capital structure will give you a tax benefit. So value of the lever firm will be higher by the amount of tax saving of a debt. Let example given is, let's suppose if VL is a value of lever firm and PUAL is value of unlevered firm, where while tax rate is T and amount of debt is D, so value of levered firm will be value of unlevered firm plus tax saving of the debt. So the value of those firms who implied capital structure will be higher by the amount of tax benefit that are gaining from using fixed income security or debt in capital structures. The other theory is pecking order theories. So financing strategy is based on the path of convenience. If the firm feeling uh, least resistance in getting financing. So first of all, the firm will use its internal financing. Then it will use debt option. Since equity is a need formality like issuing a prospectus, like hiring underwriter, hiring a brokerage, and then um, subscriptions from the shareholders, under subscription, oversubscription. So this process is lengthy and costly. So the firm will use it as a lost research. This theory is basically on the basis of easiness that a manager feel in getting uh, um, in arranging or in the composition of the capital structure. It doesn't consider any value of the firm. It doesn't consider uh, market timing. It doesn't consider uh, tax benefit. The other is market timing theory. This theory is reply to the question that how and when firm will use to finance with shares or debt instrument, in which economical situation. Secondly, this theory is based on that the firms pay attention to the market condition and in an attempt to time the market. It sees that what are the market conditions. According to these conditions, If the conditions are conducive to share issues, they raise financing through equity financing. If the conditions are conducive to the debt instrument, they are using debt to raise the financing. Choose the form of financing which at the point of time seems more valued by financial market. If financial market is is in favor of fixed income securities, then the firm will issue the debenture or bond. If the market condition is favors to issue a stock, then the company will issue a share in order to raise financing. Uh, it is basically against the trade-off theories is based on market valuation of financial instruments. So market time theory is basically about that when the company needed a finances, see the they will see or have a glance at the market and then decided that which instrument or the market is suitable for which instrument, either for debt or equity. If it is hard equity period, then issue a share. If it is hard debt period, then issue a debt instrument. Signaling theory, that is basically there are asymmetric information between manager and shareholder. Managers pay and benefit is basically eh, depend on the market performance of the firms, and that is considered riskier as compared to equity, is because it sometimes results in bankruptcy. So if bankruptcy occur, the manager will be penalized and may lose its job. So this theory suggests that managers sometimes issue a debt instrument in order to send positive signal to the market that the company have good reason to believe or have good reason to use the debt. Positive signal. Why a positive signal? Positive signal is because shareholders concluded that managers have good reason to issue a debt. This will push upward market value of the firm. So issuing a debt by a manager or by the executive of the firm doesn't depend on the value of the firm. It doesn't consider tax benefit. It doesn't consider value market timing. That is it market is conducive for debt or equity. It is just to send a signal in the market in order to increase the market value of the shares. This shares increase in the share will have positive impact on the benefits, pays, perks of the manager. So signaling theories explain that the capital structure may be because of the uh, manager's personal motives. This is all about the theories of capital structure. Thank you.